Welcome back, students who are taking financial accounting, and in this series of videos we are working on the Chapter 5 exercises Group B that were assigned in the digital study guide. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work out the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help you if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Okay, so now we're up to problem exercise 5-34B. And this one says here, Ridgeview Resources has the following account balances at January 31st, 2014. The inventory balance was determined using FIFO. Okay, so I have my inventory balance, cost of goods sold, and sales revenue. Now, remember, when you're thinking through this, you don't just read over it, okay? And then just jump to the requirements and work. When I'm thinking through this, as I'm reading this, I underline this date because I may or may not, it's like tools in a toolbox. This is information, this is a word problem. You have information that's directly related to solving the problem. You have information that has nothing to do with the problem. It's not applicable. And then you have information that you have to kind of like do math in order to help solve the problem. Okay? But you have to keep everything in mind and keep in the back of your mind if you understand the concept of where this information sits at. So yeah, I underline this date, okay, because it may be important, and I circled using FIFO, and I understand what using the FIFO method means. And then when I read inventory, cost of goods sold, and sales revenue, okay, I added these are income statement accounts, and I also, in the back of my mind, I went and said, okay, I also can figure out what my gross profit is from this information here. So, as you look over information, you're always actively engaged with the data, and in the back of your mind, trying to keep the entire concept in play. So like, you're just adding to it, and whatever you can use, you can use. Don't just blindly read over something and say, okay, this is the data, right? And then try to work through a problem. Right. Ridgeview Resources has determined that the replacement cost, the current market value at that date, the ending inventory is $30,600. Here, that's the current market value for the replacement cost, but here's the actual value that they're showing in inventory. Right, requirements. What would Ridgeview Resources report on the balance sheet at January 31st, 2014 for inventory, assuming that the company uses the lower of cost or market rule? Okay, so the whole idea here is lower. What's going to be lower? Either the cost or the market value. Okay, so lower of cost or market. So what I'm trying to get at here is that what triggers in my mind, and when I see the lower of cost or market, basically I'm saying, okay, what's my cost? What's my market? Whichever is lower is the one that gets reported. Well, in this case here, it's our cost is $29,700. The market is $30,600. So the lower of the two is going to be this $29,700. That's what's going to end up on my balance sheet. So in answer to question number one, it's going to be the $29,700, which is my cost. Okay. And then question number two says, prepare any adjusting journal entry required from the information given. Well, I don't have to prepare a journal entry because it's already on my books at $29,700. Okay, so that's it. There is no entry. No journal entry needed. because my cost is already on my books. Now, if they said that the current market value was, let's say, 28.5, okay, well then in that case, the lower of cost or market, the market is lower, so I would end up using the market value, and then I would also have to make a journal entry to reduce my inventory. So I have 29.7 less 28.5, 0.021. So I'd have to make an entry to reduce my inventory by $1,200. Well, what would that entry be? So this is 331. And since I'm reducing my inventory, I'm going to credit my inventory for the 1,200. And where does it go? Debits have to equal credits. It has to go somewhere. So that goes over to my cost of goods sold for 1,200. And so that would be my entry if my market value was less than my cost. Okay. All right, so that's 34. All right, 35. Sun Glass Bungalow had the following FIFO perpetual inventory record at April 30th, the end of the fiscal year. Okay. Remember, the fiscal year is a date that is other than, at the end of the year, that's a date other than the calendar year, meaning calendar, if my business is based upon the calendar year, my year goes from 1/1 to 12/31. But if you're talking about fiscal, generally the ending of the year ends up on a quarter, like 3/30 is the end of March. June 30, let's see, 3/31, sorry, for March. It's the end of a quarter. June 30th is the end of the quarter. September 30th would be the end of the quarter. And of course, if it was 12/31, now we're talking about a calendar year. Okay, so generally your fiscal year can be any other date. Your year. So if it was 3/31, your year would go from 4/1 to the following 3/31. Okay, 7/1 to 6/30. 10/1 to 9/30. Okay, so it could be any other date for your entire year, and it doesn't have to fall on a quarter, but generally they mostly do. You're going to start your business when you start your business. Okay, but a lot of businesses will wait for a quarter ending in order to make things easier. But if you decided to, say, start on let's say August 1st, right? Well, then that would go all the way through to July 31st. Okay, the following year, that's a fiscal year, right? That's just an aside from this problem. Because why this problem is talking about having the end of a fiscal year, okay? And we just want to make sure that that you understand what the fiscal year represents, okay? So here's the record. A physical count of inventory performed at the year end revealed 64.75 of inventory on hand. Okay, so my total cost of the inventory on the record is $92.50, but it's telling me my physical inventory only has $64.75. Remember, this here record is what's on my books. Okay, it's not my physical inventory. We go out and we do a physical count and we end up with $64.75 in inventory, which is different from our books. Okay, so it's number one, it says journalize the adjusting entry to inventory if any is required, right? Well, one is going to be required, so we're talking about 4/30 is the date. Our inventory was $92.50, and we're saying it's $64.75, so the difference between the two is $27.75. So we're decreasing our inventory, so we credit our inventory by $27.75, and debits have to equal credits. And so, if we're taking it out of inventory, it has to go over to our cost of goods sold for $27.75. So that's my journal entry, all right, to adjust my inventory to the physical count. All right. Now it says here, what could have caused the value of the ending inventory based on the physical count to be lower than the amount based on the perpetual inventory record? Okay, and we discussed this over in the theory videos, so if you want to go back and watch those again, all right? But it's easiest, I think of these things in easiest terms. I try to think, and you'll hear me use the same examples all the time. I talk about a grocery store, right? The grocery store has all kinds of items, right? In cans, in bottles, in plastic containers, milk, bread, fruit, vegetables, canned goods, soda, all of these kinds of items, right? Now, you see people going through the grocery store and scanning the physical inventory, okay? And when they have a physical inventory, your books are adjusted to that physical inventory at the end of accounting period. So when you have the ending, that becomes your beginning inventory for the next accounting period. So your books are showing this beginning inventory. Now, it's very, very easy to keep track of what you purchase, because why? When you call up a vendor and you say, I need this, 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 and this, they're your purchases, and they send in, they send you an invoice, okay? And you're able to put that on your books. So you're able to keep track of, that amount. Now, if you're using, a periodic inventory, right? You start out with a beginning inventory, and you add your purchases, and that amount just constantly, the balance on your books constantly increases until you get to the end of the accounting period, in which time you do your physical inventory and you adjust your ending to your physical. Now that takes, and that entry is the same as this right here, okay? But that entry takes into consideration everything that was sold and what they call shrinkage, stuff that was broke, spoiled, stolen, damaged, whatever, okay? It takes into consideration all of those things when you're using the periodic, right? You don't really need to track that, the shrinkage, right? And that's what they call it, shrinkage, is theft, breaking, spoiling, whatever have you, okay? So you have what's sold, and you also have shrinkage. And using the periodic takes all of that into account. Now I'm going to erase all of this here. That's what you're doing for your periodic. But if you're using a perpetual, okay, depending upon the item, grocery stores have, all of these here small amounts. Milk, if it sits on the shelf too long, can go bad. The bread can get moldy. The fruit and vegetables can rot. Okay, some kid can steal that package of bubble gum. Okay, somebody is holding a jar of spaghetti sauce and drops it and it breaks. Okay, that's all your shrinkage. Okay, but when you're doing, in a grocery store, that's all of these small items. But when you're using perpetual, generally you're talking about things that are a little bit larger. Let's say you happen to sell, odds and ends. Like, for example, you might sell lamps and, sconces and pictures, artwork, and, like maybe end tables or something like this. You know, you're able to somewhat keep track of, what exactly you do buy and sell. Now, remember, we're not talking about specific ID here, okay? But we're able to say, okay, I have this as a beginning. I buy, 10 cuckoo clocks. I buy, maybe 5 types of end tables or whatever have you. And when I sell, I have a tendency to sell them in groups. Maybe I'm selling them at wholesale. Like a thought just popped in my mind, where I knew a guy who sold like Indian stuff, dream catchers, Indian statues, stuff like this, and he would sell them as wholesale. He'd go to Mexico and he'd buy these things, bring them up here, and then he'd go around to different businesses and he would sell, each business, here's 5 for your store, here's 5 for your store. So he would keep track of that stuff as far as perpetual was concerned. But when you're doing perpetual, yes, you're keeping this record on your books, right? But that isn't your physical count. You have to go and look in the, and do the physical inventory and, physical. Boy, I can't even spell. PHY, physical. You do your physical inventory, and theoretically your physical inventory should equal your perpetual, but things do happen. Maybe he bought, let's say a statue, and when it was on the truck, just from shaking around and bouncing around, maybe that statue got damaged and he wasn't able to sell it. Okay, so that's part of the shrinkage. All right. So even though you have this amount on your books, you still have to do the physical inventory. And notice what's on your books, you're talking about, what you bought and what you sold, but it doesn't account, using the perpetual method, doesn't account for shrinkage. Okay, and that shrinkage is what you actually have, the difference between the two of what's on your books versus your physical inventory is what your shrinkage is. And of course, you have to adjust your books to that amount, and that's why you make this journal entry to your books. Okay, in order to bring your physical inventory, to bring your what's on your books into line with what your physical inventory is. Okay, so that's it for exercise 5-35B, and we'll see you in the next video for 5-36.